Welcome back to your Mortgage Minute by onlendhub.ca. We have our mortgage expert, Mouli, with us here. Today we're talking about a decision a lot of borrowers are making right now, fixed versus variable. The Bank of Canada is holding at 2.25%, but bond yields are rising, so the pricing story has changed. Mouli, what does that mean for someone renewing or buying today?
It means the decision is no longer just about where the policy rate sits. Fixed mortgage rates are driven heavily by Government of Canada bond yields, and when those yields rise, fixed pricing usually follows. Variable rates are tied more closely to the Bank of Canada policy rate and prime, so the two products can move differently even in the same month.
So, if the central bank is on pause, why are people still seeing higher fixed rates?
Because lenders don't price 5-year fixed mortgages off the overnight rate alone. They price off bond markets, funding costs, and expected future inflation. If the 5-year Government of Canada yield moves up, lenders protect margin by increasing fixed rates. That's why a borrower can hear no change from the Bank of Canada and still get a higher fixed offer.
Can you give me the math for rate impact on monthly payments? What does that look like in real dollars?
Take a $500,000 mortgage over 25 years. At 3.9%, the rough monthly payment is about $2,580. At 4.3%, it rises to about $2,730. That is about $150 more per month or $1,800 more per year. On a $600,000 mortgage, that same rate move can add roughly $180 a month, which is more than $2,100 a year.
And what about variable rate? People always ask whether the discount currently available in variable rates is enough to justify the risk.
Use a framework. First, ask whether your budget can survive a payment increase without stress. Second, ask how long you expect to hold the mortgage. Third, ask whether you value certainty more than optionality. If a variable rate starts lower than fixed by, say, 0.5%, but the market sees one or two more possible moves, you need to decide whether that discount compensates you for the uncertainty.
Let's make that practical. What if someone has a $700,000 mortgage?
At 4.1%, a rough 25-year payment is about $3,700 per month. At 4.6%, it moves closer to $3,900. That is around $200 a month or about $2,400 a year. If a borrower is already stretched by property tax, condo fees, or childcare, that difference matters. If they have strong cash flow and want prepayment flexibility, variable can still make sense.
Where does the red flag show up?
The red flag is choosing variable because it feels cheaper today without checking how much room you actually have if the payment rises. Another mistake is locking fixed too early out of fear, then paying a premium for peace of mind that your cash flow didn't really require. The right answer depends on stability, term length, and how much rate risk you can absorb.
So, what's the decision framework our listeners should use this week?
Use 2 lanes. Choose fixed if payment certainty is the priority, if your debt ratios are tight, or if a $100 to $200 monthly swing would create stress. Consider variable if you have a cushion, expect rates to fall later, and want the flexibility to benefit from future cuts. In a rising bond market, fixed is the defensive choice and variable is the strategic bet.
Will a hybrid rate strategy work?
Yes, it could work depending on your specific financial situation. You could take a variable rate first and switch free of cost to fixed when you think rates are stabilizing and vice versa. Consult a licensed mortgage broker for advice.
That's a clear way to frame it. So, the big takeaway is that the Bank of Canada pause does not mean mortgage rates are flat, because bond markets can still push fixed rates higher. The second takeaway is that the best mortgage is the one your budget can actually carry, and the third is that the right choice depends on your risk tolerance, not just the headline rate. Thanks for listening to your Mortgage Minute by onlendhub.ca. We'll see you next time.